Anonymous asks, and this is a question because I used to see it all the time in practice, Martin. You get people walk in and they had all these old shares from 10, 20 years ago. And by Anonymous, Jess in my team actually asked this. And I'm like, it's a good question.
Yeah.
For older Aussies who might inherit single shares from previous generations, like companies like Telstra or IAG was a big
NRMA ones,
NRMA, is there diversification risk? Would there be benefit to selling those and buying ETFs instead, especially for older people who don't know much about investing and these shares have landed in their lap? So almost every client that I had in 2015 or beyond, in that era when I was doing advice and retirement advice, would come in, we've got the old Telstra shares. And my parents either...
T1 or something.
They bought T1. I remember the prospectus that was sent in the mail and Dad's like, might do that. And, they would put a couple of grand in there or $5,000 and, a couple of things, issuer sponsored, so nightmare. What do we do with these shares? And maybe first we can explain what issuer sponsored is and the nightmare that it is versus like a CHESS sponsor or a HIN.
Yeah.
So I'll let you do that.
So acquiring shares, and it goes towards this, is you can acquire shares in different ways. If you're often proactive about it, might be I've set up a share broking account, I've decided I want to buy some shares, I know what I'm buying, I'm purchasing 1,000 or 5,000, and typically you've done that through a broker, either paid an external broker or used an online platform. That's going to be under a HIN or a HIN or a CHESS sponsored.
Yeah.
And that means you can have multiple shares under the same number and track it and transfer them and sell them much more conveniently. The other way to acquire shares is that you might have just inherited them, you might have been given them, or you might have subscribed to them when they first listed, either actively or just, passively, i.e., I had an NRMA insurance policy and all of a sudden now I've got some IAG shares. They will have come to you under an SRN.
Which is a security reference number.
Yeah, and if you want to know, I don't know which my ones are, you find a statement and you'll find a letter at the front of those. If it's an X, that means it's under a HIN. If it's an I, a capital I can sometimes look like a 1, that means it's under an SRN. Either way, you still own them, but how you then act on them or do something of those can be slightly different.
So it could be confusing. So the HIN is the holder identification number, and you did touch on it. I could open a NAB trade account, ComSec, SelfWealth, and they act as my broker, and I could hold 10 different shares or ETFs. Through my broker, they would place the trades. I've got the one HIN for that broker.
And all of the 10 shares that sit under
have
them?
the same number.
All on the same HIN.
Yeah. But if I had, IAG and NRMA, or IAG, NRMA, Telstra, maybe
AMP or Combank or,
your SRN, there would be a different number for each parcel of shares.
Agreed. Yeah.
So that's just a bit of the lay of the land. When you've got a HIN, it's often linked to a broker.
Yep.
Easy to sell, log in, sell, done. The SRN, it's a pain in the ass to sell them. You might need to pay a broker to do a once off, and the process has changed over the last 10 years to try and offload them.
Security, different reasons. So often there's 2 or 3 ways to sell them if they're an SRN.
Yep.
One is I go and set up a broking account and I can transfer it in. So I go and set up a HIN with an X and I go, hey, by the way, I've got these existing shares under SRN. Can I move them across? Once they're across, you then go and sell them. There used to be a lot of one-off brokers that would allow you to sell under an SRN without having to set up a new account and put all your details in, etc. I believe they still exist, but they're less common because of a lot of anti-money laundering and security rules, etc. Or the third option is often the share registry, computer share or link, will have a service inbuilt where they will let you sell them as long as you meet certain conditions. Often it's less than, say, $15,000 in value. Often it can't be in joint names. It can't be in a trust or an SMSF or a company. So that's a whole path to go down. But so often you can just sell them that way to tidy them up.
Yeah. So we did mention another acronym CHESS, which is the Clearinghouse Electronic Sub-Register System That's basically the system that allocates the HINs with the ASX.
Very good. I'm not sure I knew what CHESS stood for.
Yeah.
So there you go. I've learned something today as well.
And what does ASX stand for?
Australian Security Exchange.
Yes. Good boy.
An exchange often has an E in front, but ASX sounds better.
And securities aren't just shares.
Fair. Yeah.
They can be bonds. They can be anything traded.
Hybrids. Yeah.
All that stuff.
Yeah.
Well, just checking you're up to speed, my friend.
I've still got it.
Okay, so all that housekeeping aside,
come back to the question around
Jess's question, she might have been talking with her parents or uncles and aunt, like, oh, we've got these shares. I think we need to look at perspective here. So if someone's got $300,000 or $400,000 in super, they might have $3,000 or $1,000 of IAG shares. I think in that instance, Martin, and I know this with my parents, just for housekeeping and ease of paperwork, just piss them off.
Yeah. Come back to why we acquired them, and often it's we haven't acquired them, just land on our lap. Are they nice to keep and hold? Perhaps, but going back to, are we really getting a return on them? Are they properly diversified? No, they're not, because they're in one stock. If we're on to Centrelink, that's just more things we have to report to Centrelink. If we're retired and no longer doing a tax return, do we want to declare that dividend and try and get the franking credit back? If we're going to hold them forever and pass it on the estate, that's just more paperwork the estate has to tidy up and fix. And are your kids going to really want half of your IAG shares in 20 years? Probably not. So in most cases, part for the diversification, but part what you're saying, just a simplification, we would often tidy them up and sell them.
Yeah. So part one, housekeeping, relatively small amounts in your world. Now, relatively small amounts, if you've got $3 million in super and $30,000 of IAG shares, probably still housekeeping, might want to tidy it up. So it's all relative to the situation.
Yeah.
Now, if we up this a little bit further, that's kind of the first peg. The second peg, what if, mum who was 94 died, and we have talked about this before on the show, she left $500,000 worth of CBA shares to someone in their 50s or 60s. Well, that's now a real discussion about diversification.
Yeah, definitely. And that goes down to, well, what happens in that case? So let's say mum hasn't sold them when she's alive in her 90s. That goes into the estate. The estate can decide, do we want to sell these CBA shares and distribute cash to the beneficiaries, or do we want to pass on the shares? That's an optional decision the estate's got to make, and there's pros and cons to that and potentially a tax event around that. But let's assume that the estate hasn't sold them and they've passed them on, either to one beneficiary or divided by 2 into 2. Exactly the point. If I'm now 62, I've got 500,000 in super and I've inherited 400,000 of CommBank shares.
You're overweight pretty heavily in CommBank.
Half my retirement wealth is kind of in one stock. I think we need
pretty
to
good
assess
stock in the last couple of years,
Definitely
might I say.
I had a detailed meeting with a client yesterday who very close to this example, and it has been a great stock, and it's going to have some tax headaches to sell, but the concentration risk and the lack of diversification from the question is definitely something to consider.
But every good stock that has gone to the moon and done well, there's a million others that haven't, and that's why we just have to step back, have a cold shower, and say that. My name is Glen James, joined by Martin McGrath, Financial Edge Group, here on Retire Right. Welcome to the show. Martin, you ready to have a chat?
Let's cover some questions.
This is a podcast that will help you plan and execute one of the biggest moments in your life. That's retirement. You'll learn how to set up your finances in a way that benefits you, your lifestyle goals, and keeps you in the know within this complex world of money and investing. Your host is Glen James, former financial advisor, author, and host of the popular Money, Money, Money podcast. Glen is joined by experts in various fields around the topic of retirement in Australia. Any advice in this podcast is of a general nature. Full details are in the show notes of this episode. You only retire once, so retire right.
Rightio, if you are new to the podcast and Retire Right show, welcome. Just a little bit of housekeeping. We can't give personal financial advice. We have people email in. Awesome. Maybe if you want something answered on the show, absolutely email and go, I've got a question for the show. You can go on the website. There's a form there. But we've had a heap of people write in, hey, Glenn, hey, Martin, what should
What
I
do in my exact
Can you let me
situation?
know? We can't actually reply and say this, but we can take questions and use them in a general sense for content
Things
for
to
the
consider.
show.
Yeah.
But if you do want a financial advisor, you can head to retireright.com.au, click Get Help. I'll have a look at that and I'll refer you to the most appropriate business. It might be Martin's business if you meet the certain criteria, because, you want people that are, a certain way.
Yeah, I mean, in terms of our business, we've got a speciality. Retirement's all we do, but we definitely do work with a lot of former small business owners or kind of complex structures, SMSFs, family trusts, those kind of things, or property investors. So, therefore, that's our expertise and often our kind of pricing structures around that. And so if we will let people know, but Glen also knows the right fit for us and not the right fit for us.
Yeah. And I'm not going to waste your time when you ask for an advisor to send you to an advice business who they're going to be like, we can't help you for these reasons. So that's just a bit of housekeeping there. Hey, following our series on money in your 50s, 60s and 70s.
That was a fun one.
It was good. There was a question on the YouTube from STJ Emrad. What about extra non-concessional contributions versus paying down the primary place of residence or investment property mortgage? Now, before we get into that question, Martin, there was some chatter in the Facebook group probably a few weeks ago, if you're listening to this, when that episode first dropped, about, because we talked about if you're at a certain age, mid-50s or whatever, there could be a benefit of minimum mortgage repayments, pumping super.
Yep. For the
then
tax benefits.
when we retire, and then there was some chatter in there about the feeling of peace and security by just attacking a mortgage. And that's totally fine because it's a tax strategy, the pumping super and withdrawing when you are, an
late
age to get
50s,
that.
early 60s. Yeah, and that's where personal financial advice is personal. There's no right or wrong answer with this, and that episode and episodes like these are food for thought for some people. Might go, I understand I can save $5,000 a year in tax, but
But at what cost?
My sleep at night factor
Yes.
is not worth that. Whereas other people go, I want to pay the legal amount, but the minimum amount of tax as possible. Explain all the options to me. And I'm okay knowing that, yes, my mortgage might be $50,000 higher, but my super is $100,000 higher. And I know there's a door at 60 that I can open to start to pull that out. There's no right or wrong answer there. And that's kind of where that foundation was. And this question's kind of jumped in on the back of that.
Can I also potentially add as a bit of a challenge, because I will confess I'm not in my mid to late 50s. I might look like it, Martin.
Are you in your 70s or?
Yeah, knocking on 70's door. What about some type of compromise and some hedging of risk? Because there was chatter, people legitimately being made redundant, losing employment in their 50s. It happens.
Yeah.
There's people in their 20s and 30s that get made redundant and 40s, but it can feel a bit harder as we get older for whatever reason to try and, get back in the workforce.
Yeah.
May I suggest if you are in that 50s age and you're like, oh, I really like the idea of paying down the mortgage for that security as opposed to optimizing my tax savings, we talk about having an emergency fund. I'm okay if you say, look, we want to build a $100,000 emergency fund or a year's worth of income. Usually we say 3 to 6 months. But if you want to say, look, at all times, we want to have $100,000 in an offset or redraw or insert your thing here. So if you do get made redundant, there's 12 months of buffer there that can, cause you less anxiety.
Yeah, definitely.
So that's an option as well. To just keep cash heavy first, we're going to save 80, 100, 50, whatever your number is, higher than what the textbook 3-month emergency fund is. Then once we do that, we're going to start the tax strategy.
Yeah, even do 50-50 the tax strategy. So
you don't have. It's not all or nothing.
It's not all or nothing. And even at that point, it's around, okay, well, many people might have their mortgage paid off by 60, but many might not. And so then it's around, okay, well, does it really matter if it's paid off in 62 versus 64? knowing that at 60 I can maybe use some of my super to pay that off. And I think that's the other part that hopefully people took away from that is that we didn't even know that was on a table on the option, option on the table to at least explore. So,
okay, so having all that, said all that, the question again, what about extra non-concessional contributions versus paying down the house or investment property mortgage? Is it fair to say because the investment property mortgage is tax deductible, it's last on the chopping block?
Yeah, I think, and I think also based on what we just said, I think these questions come from on the basis I have maximised my concessionals.
Yeah.
So I think that's what I'm saying. Thanks for that. But what about extra non-concessional? So I think they're kind of saying, let's say I'm happy with that strategy that was discussed on the podcast. I'm going to maximise my concessionals. We know there's certain limits. You can only do $30,000 a year, including your work contributions. So that might only be $10,000 a year. So now you've got an extra $20,000 a year on top of that. Where does that go to next? And so the three options is, do I pay down my home loan debt, or do I pay down my investment property debt, or do I put extra into super voluntarily? Again, personal preference, and we can run projections to show you which one or the other, but for me, the hierarchy typically would be, if we're looking at the two debt options, yeah, you've summarised it well. Well, my home loan debt, my bad debt, is going to come well before the investment property debt. And I would say that's going to come number one after your concessionals. Number one, concessionals. Number two, pay off your bad debt.
If we are, if someone is in a position to be fortunate enough to cap out the concessional cons and do this tax strategy, because effectively that's what it is. We're not putting extra on the mortgage. We're going to cap out our concessional cons.
Into super, yep.
We might then use some carry forwards, catch up the last 5 years if there's any holes. The question then with the non-concessional contributions, it's not a year on year, and please correct me if I'm wrong, Martin, because I'm just trying to learn like everyone else. The question is, well, it's not a year-on-year tax strategy. It's a future wealth creation strategy, and I want my money growing in a tax advantageous environment. Is that a fair statement?
I think that's fair. Yeah, I think that's fair. And return on investment.
Yeah.
So looking at that, let's say I've got 10 grand surplus after I've done everything else. If I pay my home loan off, I'm going to save myself 6% in today's market. But that's an after-tax 6%. So before tax, I'm actually getting a decent return as a guaranteed return. It's not growing, but it's saving me interest against my home loan. Question two is, if I pay it off my investment loan at, say, 6% as well, my 6% on my investment loan is a tax deduction. So the 6% is not actually really 6%. I can claim that back on my tax. So it's probably effectively a lower rate of return versus if I put that $10,000 into super as a non-concessional, no tax when it goes in, but now it's invested in my super, what return am I going to get on that versus what potentially the interest I would have saved elsewhere?
Question, and this is circumstantial, if someone had I'll make some numbers up. Someone was 55 years old. They had an extra $30,000 a year after tax, after capping out the $30,000 concessionals
and yep.
If they were in a fortunate enough position just to have $100,000 left on the mortgage, you might take the view, stuff this, we're just going to pump the mortgage the next 3 years. That's done.
That's done.
Then we'll attack super.
I would think so. Yeah.
You can do whatever you want, but it is a difference there of everyone's individual circumstances.
Yeah, and I think looking at it through a perspective of financial advisor can run these numbers for you, can put into a spreadsheet what return is this getting me versus that. And the benefit of the mortgage is that it's a guaranteed return. Doesn't matter what the share markets or your super fund does. If you pay that off your mortgage, you're saving that interest. There's a buying power of inflation that maybe the spending power is less, but it's not going to change in volatility. It's not going to be higher. It's also not going to be lower.
And I think it's important to be loud and clear. Paying off the mortgage is a really good financial achievement.
Yeah.
And there's something out there in society about maybe keeping the mortgage. And we talked about in the 50s episode, and now it's as a tax strategy, it might be better over the next 10 years to pay minimum and do the rest. But an example of this, I talked to somebody last week in their 30s. They were a small business owner, and she's got a mortgage of, I think she said $500,000. She sold one business, bought another one.
Mm-hmm.
The business sale proceeds after tax, she's getting about $750,000. And, there's on the new business, there is tax deductible debt, which is awesome. And she was asking me, like, what should I do with this money? And I'm like, for me, and this is just my personal thing, there's no way on the planet I would not be clearing my mortgage and be debt-free. And if you want to go ahead and buy an investment property one day or buy shares one day, you can borrow against it in a tax-deductible manner. But she just had this in her head that paying off the mortgage might not be a good thing.
It's too boring, but boring is sexy. Boring is important. And you're right. In our 50s, we're talking about super. I'm thinking the episode about in the 60s was like, have a plan to be debt-free. So 100%, we want to be debt-free against our home loan at some point. One way or another, whether that's using super, whether it's selling an investment property, and that might be I don't think there's a clear answer here of should I do non-concessional, should I pay off my investment property? The way I would answer that with the client if I was talking to them was reverse engineering, where are we going to be in 5 or 10 years, and how is this investment property playing into the scenario? If it's a case of this investment property, my family's living and I'm going to need to keep it for the next 20 years, well, we need that to be debt-free, or we want the head towards being being debt-free. So that might be the focus of paying down the investment property after your own home loan's paid off. If it's the opposite of, when I get to 63, we're going to sell that property, it's been a headache, there's a capital gain, we're not going to sell it now, I perhaps wouldn't focus on paying down the debt, because the debt being higher is tax deductible while I'm working. And if we pay it down too much and sell it and get too much equity, we might not be able to get that into super at the time. So rather than having using an extreme figure, an investment property of $1 million paid off completely, I sell that at 63, I can't put all that into super. If I had done the opposite of pumping into super early as some non-concessionals, and there's still, say, $400,000 of debt on that investment property when I sell it for $1 million, clear the remaining debt, that 600 left over between me and a partner or a spouse, I can get that into super. So I think that's the non-concessional versus paying an investment property, comes back to what's the exit strategy or what's the end game for the investment property, I think dictates that decision.
Yeah. And potentially, what do you, like, we don't know this person's age. What's their age? What's the plan for the PPOR? Mm-hmm. Are you happy to live there in the next 20, 30 years? Or are you like, we're pretty much going to get rid of it? Still, it's okay to still pay the debt down, but
we know that's going to be an exit. Or I've a few clients recently, that investment property is going to be our retirement home. Well, then we do want that paid off.
Yeah.
Or vice versa. If that's going to be paid off, it's a holiday home worth $800,000, a house we're living is worth $2 million, we're probably going to sell the $2 million and move into the $800,000. Well, that $2 million is going to have to go somewhere. That's going to clear a fair bit of debt or go into super at some time.
For those that have multiple investment properties, and because I was thinking about this for myself the other day, like at all times, the properties that I've got, I know the one that's on the chopping block first if I need to sell it. Mm-hmm. And that's the question as part of your strategy. Like, which is the ugly duckling that you're going to sacrifice and rather, I don't know, because it's such a big transaction.
Yeah.
And I'm not saying the one that's my ugly duckling hasn't performed well and all that, but it's the one I don't like the most for a few reasons.
Different reasons, yeah.
And I'm even thinking I probably will get rid of it in the next 10 years.
Yeah.
And not hold forever.
And I think, not quite in this question, but that raises something that there's a few clients that come to mind I've helped in the last year or two around that. And actually, one of them referred was from Rach, from the mortgage broker, the property podcast.
Yeah, so we do a podcast called This Is Property. It's also on YouTube and on podcasts.
And so she had a client she was working with that had multiple properties and had multiple loans and wanted to purchase more but had a bit of a banking cash flow issue. There was plenty of equity there, but just the rent coming in, the mortgage payments going out didn't quite stack up. So it needed a bit of an overall plan and a strategy. And round figures, might have had $6 million of investment properties and $2 and a bit million of debt. So plenty of assets there, but cash flow was really poor for different reasons.
And what, she didn't want to sacrifice one on the
And just
altar
thought,
of
well,
life?
don't we just keep them all forever? Isn't that the only way to achieve retirement? And sitting down in their late 50s going, I don't think you're going to pay off that $2 million of debt in the next few years just from cash flow. We're going to have to liquidate one or another. And so it's now been 2 years, and ignoring their wages, the properties 2 years ago, there wasn't much left over at the bottom. We caught up a couple of weeks ago. Those properties now, I think there's worth $5 million of property and $600,000 left of debt. They're now pumping up $100,000 a year of cash flow after the mortgage repayments are sorted.
Is it all resi or some commercial?
Mainly resi.
Wow.
But just by liquidating a couple, some were on P&I because they'd been in place for so long. Some were just under market rents and needed to make a bit of adjustment. And we did a refinance as well that helped. But so net asset position, still very similar, 4 million give or take, but cash flow position very different with a bit of a strategy in place.
I would say as part of this strategy as well, it might be an argument to switch your investment property debt to interest only if it is on a principal and interest.
Yep.
Like if you had lived there and you just moved out because you'd want to divert that extra principal repayments to your principal place of residence. Yep. We'll be back right after this.
If you're after personal financial advice, don't get it from a podcast. If you would like help based on your own personal situation, head over to retireright.com.au, click Get Help, and we'd be happy to introduce you to one of our trusted professionals. Our panel of vetted financial advisors and mortgage brokers work with people all over Australia, so they can connect with you wherever you are. That's retireright.com.au and click Get Help.
Another comment that was on the 50s video, Martin. If you had, and this is a quick one, I think, but who knows? We sometimes go, this is a quick question and spend 25 minutes. Shane, A9613, irrelevant, but that's his handle. If you have over a 500K in super, can you still use salary sacrifice up to the 30K cap? I understand you can't use the carry forward from previous years of the unused cap if you have a balance over 500K. So that's correct, his second point, but is there any circumstance where someone could not use if they're eligible for a concessional contribution of, at the moment, $30,000, are there any circumstances in your financial life that you can only pay in a 12% SG?
No, as long as you're under the age of 75 or 67 in a work test, but short answer, no. So can I still do up to 30 if I'm above 500,000? Yes, you can. So that was a quick answer of yes.
But so on that, off the top of your head, the 500K super balance threshold, that triggers a couple of things in the wild?
The main one being this, can you use catch-up contributions or not?
And what about bring forward?
Bring forward, you can do, that's if you're closer to the 1.9 or 2 mil.
Yeah.
So 500 itself is the catch-up. Yeah, there are certain other limits for the non-concessionals of whether you can use a bring forward or not.
Yeah.
And they're 1.68, 1.78, kind of close to
So the
2
bring
mil.
forward's the non-concessional
non-concessional
contributions, bring forward 3 years.
Yeah.
And then and this is why we always have to say it because it's bloody confusing, the carry forward is the previous 5 years of, like the questioner is asking, if your employer was paying 20 grand for the last 5 years, this year you could effectively put in 50 grand and claim it on tax.
Because you've only got 480,000 in super. You've got the taxable income to use. I think that's important as well. But yes, otherwise, whether you're at 600 or 400, you can still use the full 30. You just can't use more of the catch-up if you're above 500. A couple other asterisk points on that. I'd touch on one of those very briefly. You have to have the taxable income.
Yes.
So I've had that also happen recently. I want to go and do this catch-up. I've heard about a catch-up I could do. I've got 80,000 of catch-up to use. Should I go and do it all today? What's going on? Well, I'm not working. I've got about $3,000 of interest income. I don't think that catch-up's going to be beneficial. And in fact, the ATO won't let you put yourself in a loss and pay tax on that if you don't need to. So that's one reason when you maybe can't use the 30 and you can't use the catch-up. There are some rules if you're a certain age, over 75, where you can't do extra personal concessionals. Beyond the age of 67, if you still want to do concessionals, you have to meet what's called a work test to be able to do those. But up to the age of 67, you can still use that 30 grand cap, even if you're not working. And so that may be relevant where I've stopped working at 62, I'm enjoying life. At 63 or 64, there's no reason to put money into super because I don't have enough taxable income. But at 65, I've inherited a share portfolio from mum, and that's got 400 grand of CBA shares. A call back to before, my accountant's told me, I've gone to see an advisor who said, if I sell these, I've got a big capital gain. Maybe I should use either a catch-up if you're below 500 or a concessional of 30,000 to reduce that capital gain. So just because you stop working doesn't mean you can't do concessionals. But if you don't have a taxable income, there's not a lot of point to use those.
Finally, Ted asks the question, and this is an interesting question. Downsizing and contributing to super, or keeping an investment property in retirement, which works best? Let's just, before we go to Ted's question, and this is what maybe triggered me, the D word. When we talk in the financial world, if people say downsizing or potentially the downsizer contribution, that triggers that thought of PPOR, sell, put money to super, extra 300K per person above all the caps. Just explain, probably a bit clearer than my brief summary, what the downsizer contribution is and how it works. And then we'll swing back around and say why we might be confused or Ted might be confused, and we'll have a chat about it.
Yeah, so just very briefly, trying to cover off as clear foundation as possible. We just talked about concessionals, so it's putting into money in super and saving on tax. There's non-concessionals where you voluntarily put money into super, and in addition to that, there's called a downsizer contribution where you're allowed to put, as long as you meet 3 criteria, over the age of 55, you've sold a house that you have lived in for a period of time, and you've owned that property for over 10 years, you have 90 days to put up to $300,000 per person tax-free into super. There is no age limit other than you have to be over 55, but it's okay if you're 56 or 86 or 96, you can still do a downsizer contribution. 300,000 is the cap, but you can do anywhere from 0 to 300,000. And doing a downsizer doesn't stop you or make you ineligible for doing either of the other two that I'd mentioned before. You can do them in coordination.
Question on that. If a couple downsized, they sold a property for $1 million and they wanted to move to a villa somewhere in a regional centre for $400,000. They'd capped out all their other super. We can each put... They'd own the house and lived in it over a 10-year period. And that's an interesting, you don't have to live in it for 10 years straight. You just have to have owned the property for 10 years at least and lived in it.
And lived in it for a portion of time, correct.
Do we know the actual portion?
I don't. There's not a clear answer of 40 days or 60 days. Right. It's proved that it was a principal place of residence
you'd had
for a
called
period
it home
of
for
time.
a period of time. Okay.
So if it's been rented out forever, it's probably hard to. But if you lived in there for a week or a month or 6 months, then you've lived in it.
So this house they sold for $1 million. It was in joint names. One of the couples was 55, so they put the $300,000 in
as a downsizer.
As a downsizer contribution. Can the person that's a year younger at 54 put the 300 in because they're attached to the house and their spouse is over 55?
Unfortunately not, no.
Okay, so this is where in these situations, step back and do a little bit of planning. If we are going to sell this, we think on balance it might be worth waiting an extra year.
That's an option. So how to fix that? Wait an extra year, or the younger spouse can still do a non-concessional of up to 360. Now you've said they've capped it out, but let's say they hadn't. Or the older spouse can also still do a 300 downsizer and a 300,000 non-concessional.
Yeah. So it's not the end of the world. So
either plan and delay it by 6 months, or consider an alternate and matter. And that also, picking up and running with that, if I've got a 62-year-old and a 56-year-old, they could both do the downsizer, but depending upon their strategy, it may actually be beneficial that the older individual does the downsize of 300 and does the non-concessional. Because then next week, if they want to live off that income, they can. Whereas the 56-year-old, yes, they could do a downsizer, but they're not old enough yet to start an account-based pension. So going back to the strategies or the products are a great thing, but what is your strategy? What are we trying to achieve here, and making sure that you're using the right strategies to meet what your plan is?
So back to Ted's question, when he said downsizing and contributing to super, one thing, or keeping an investment property in retirement, which works best? Okay, maybe he's thinking, I just want to say one thing. There was someone in the Facebook group, they had asked multiple questions. They'd sold an investment property, put the money into super, tick the box as a downsizer. You can't sell an investment property and use this $300K per person gateway to put extra money into super.
If you've never lived in it,
If you've never lived in it, you can't do it. It's an investment property.
Yeah.
And this person made a mistake, put the money in. The super fund will not be able to change that once you've done the declaration, and it's royally effed. So I just want to say that loud and clear. But I think the more we look at this, downsizing and contributing super, or keeping investment property in retirement. I was thinking they had an investment property.
I agree.
I think they're now saying maybe there must be other money there. Like, keep the property as an investment and buy something else.
I think
sell it and buy an investment property.
The way I'm going to answer this question that may or may not be asked is, I'm not downsizing my home. I'm Ted, or I'm the version of Ted. I've got 200,000 in super, and I've got an investment property worth 600. And I'm 65. I don't want to retire. Do I retire and keep my 200 grand of super and the rental property, and is that my best retirement, and have the rent coming in plus a bit of super, and will that meet my needs? Or am I better off selling the investment property for 600, putting that into super and now having 800? Ted would need a partner to be able to put that much money in, but what's going to get me a better retirement? An investment property and a bit of super, or a larger amount of super?
Well, from a tax perspective and liquidity perspective and flexibility perspective, super all day long.
All day, yeah.
Yeah, I don't know. We just don't know enough information. Downsizing to super or keeping an investment property in retirement. So I will say, if you've got an investment property and you've got your own principal place of residence, you can sell that and put money into super as non-concessional and bring forward. That's fine. You just can't use the downsizer contribution.
No, so back to that.
And maybe maybe he's not talking about downsizing contribution, but more of a physical, we're downsizing.
Or simplifying affairs. And it goes back to the IAGs or Telstra shares that in my retirement, do I want to have one investment property, 3 little shares hanging around, and 2 different super funds of 100 grand each? Or do I consolidate all of that, move it into one super fund, sell my investment property, tidy up the shares, put that in? Maybe, again, if I've got 200,000 or 300,000 in super, that investment property might have a capital gain. But if I'm selling that at 65 when I've retired, I can use a carry forward contribution and probably reduce or eliminate a lot of that gain. Then it's around what's a better investment, a rental property versus your super. There's no right or wrong answer there, and a somewhat personal preference. But remember that your super doesn't equal the share market.
No.
You can pick and decide what your super's invested in. But the point you raised there around which is going to be more tax efficient, superannuation is going to be 0% tax the rest of your life on the income and the capital gains and what you withdraw, whereas the rental property, you might end up paying tax on the rent, you might end up paying capital gains. If you pass that rental property on to your kids, they're going to pay capital gains on the rental property. So, and then liquidity is one of the biggest things that I find to come across. That I like property. There's lots of people who make a very successful future and financial position out of retirement, out of property in their retirement. But if I'm going back to the example I spoke about before, that client I helped, properties and potentially residential properties don't always generate the best cash flow. So if I've got a $600,000 rental property, by the time I pay the rates and the insurances and the agent's fees, etc., I might be getting a 2% income return, and I might want more than $12,000 a year to live off in my retirement. Whereas it might be growing by 20 or 30,000 a year, which is great, but I can't spend that capital growth until I tap into it. So often we find that property might be a great way to build my wealth towards retirement, but often it's let's review this, and do I sell one to clear some debt? Do I sell one to open up some liquidity? Perhaps I've got 3 and I keep 1 or 2 in retirement, but often, unless I have substantial other liquid assets, it's probably looking to sell at least 1 to simplify things.
And this is such a great example to kind of finish on and promote the value of financial advice that's personal to someone's situation, because Ted's asked the question, which is one sentence, and says what works best. I've written down a whole heap of things that we would need to know to
start
actually
to analyse it.
Yeah. So the first one, your assets. What have you got in super, outside super? What's the investment property worth? Is there any debt on it? Do you have an investment property? What's the home value? Is there a mortgage on it? What's your age? Do you have a spouse? What's their age? What's their income? What's your income? Do you have kids? Do you have grandkids? What's your health like? And then this kind of all goes back to these 2 questions, Ted. Number 1, what do you want to do? Like, just what do you want to do? What are you thinking? And why? And that feeds into, well, what are your goals in retirement for your lifestyle? Because once we work them, then we work backwards. So if you do want to speak to a financial advisor, Ted, you can go to retireright.com.au, click Get Help, and I'll introduce you to someone to have an initial chat with. But we'll leave it there. Martin McGrath, thank you so much for your time today. Hey, if you want to join the Facebook group and continue the conversation, when we say, where did you hear about the group on the entry, it's called Retire Right, the Facebook group, just say, I heard Martin and Glen on episode 333. Then we know you are not spam. My name's Glen James. This guy is
Martin McGrath.
And you've been Retire Right. Bye.
Any advice is general financial advice only, which does not take into account your objectives, financial situation, or needs. Because of that, you should consider if the advice is appropriate to you and your needs before acting on the information. If you do choose to buy a financial product, read the Product Disclosure Statement, PDS, and Target Market Determination, TMD, and obtain appropriate financial advice tailored to your needs. Simo Interactive, Pty Ltd, and Glen James are authorised representatives of Money Sherpa Pty Ltd, which holds Financial Services Licence 451289. Martin McGrath, Financial Edge Group, and its employed financial advisors are authorised representatives of Synchron Advice, AFSL 243313. Opinions or comments from any guest on the podcast are theirs, and not those of the hosts, the publisher, or their respective licence holders.